Hello, Business 330 students. This is Professor Hassey. It's our week 3 update video. Today's date is Saturday, June 24th, and I hope you all have had a good week. As we conclude our time value of money segment of our class, this week number 3, we'll talk a little bit more about the time value of money. I'm going to review now that everybody has completed and all the grades have been posted for assignment number 1. I'm going to talk a little bit and review a little bit of assignment 1, let you know my thinking and my grading policy. And then we'll prepare for our next week in talking about stocks and bonds and our another assignment video, number 3, which will be posted on Monday, June 26th. So that's where we stand in class right now. And let's take a look at this. Now, as we begin to accumulate some grades, you have your portfolio set up in this week number 1. You have your professor meeting, and now you have assignment number 1 all posted to your grade center in Blackboard. If you go to this report card section in the front of your Blackboard platform, you'll see your grade. You can click on that and get the details of your grades, and that's your cumulative averages as we go forward every week to week in our class. Also, if you go to the assignments and examinations file folder, you'll see the assignment number 2, which is due this Sunday, June 25th, and then also the solution file to assignment number 1. So if any of you had some questions or want to compare your answers to the solution file answers, please feel free to download and take and look at that. Remember, these assignments all lead into the final examination, the last week of our course. So the assignments accumulate over time, and certain problems from each one of the 4 assignments will be in the final examination. So it's good to keep these as backup and as reminders or study guides heading into the last exam of our course the last week in July. So let's take a look at assignment number 1 and some key parts to that. The main focus of assignment 1 was just to make sure you have all the definitions down in regards to corporate finance, and also some brief questions about using financial data in regards to companies, in regards to key financial statements like the income statement, the balance sheet, and the statement of cash flows. So again, each problem, I give you the chapter that the problem was from, and also the points that it was graded as part of the graded weight of the assignment. If you got the problem wrong, I highlighted it in green or yellow, and in red indicated the number of points I deducted. In some cases, I gave the answer typed into your file, or I refer you to the solutions file in Blackboard. So I uploaded this file after I graded it, and it's in your grade center if you want to review it. The first 2 questions, pretty straightforward. Not too many people had any problems with that one. The same thing holds true with the third question about the 2 major decisions that financial managers make. They have to determine where the investment and the capital investment decision is going to be, and then how are they going to pay for it. Those are the 2 main decisions of financial managers or corporate finance. Question number 4 was multiple choice of which of the following groups is least likely to be considered a stakeholder. Remember, the definition of a stakeholder in a firm is somebody who gets some benefits out of the performance of the firm. Naturally, competitors would probably be the least likely. You don't want to help your competitors in the management of your own company. So the answer is C there. The question number 5 is a difficult one as far as grading is concerned. My correct answer is D. That's the best answer of the 4. That now all 3 could be considered somewhat answers for that question, the cost of capital, but the best answer is D. A is the expected rate of return. Well, that's the cost of equity. That's not the entire cost of capital. Opportunity cost is determined by the risk-free rate. Well, that's how you determine the cost of equity. And is the interest rate that the firm pays on a loan? Yes, that's your cost of debt, but it's not the total cost of capital. So the correct answer is D. And you got, it depends on which A, B, or C you answered. Maybe you got 1 or 2 points off, but it was a fairly, I gave you all answers were fairly correct, but the best answer is letter D. Question 6 can be a little confusing for people. Which of the following information is not provided by the financial markets? Microsoft earnings is provided by Microsoft, and they give that information to the financial markets. So the correct answer is C. All the other 3 are provided by supply and demand and market indicators of various financial markets, money markets, commodity markets, interest rate markets. But C, that information is provided by Microsoft to the financial markets, and that's why letter C is the answer. Question 7. This is a difficult question, and usually in every assignment exam, I always have 1 or 2 questions that separates the A student from the A- or B student, and this is one of those questions. It's asking you to interpret the definition of financial statements and calculate that out. And here was my thinking on this. You are asked to determine the earnings before interest and taxes, the net income, and also the cash flow from operations for this company. Now remember, cash flow from operation is one of the 3 areas of the statement of cash flows. The others are cash flow from investments and cash flow from financing. So I give you a series of financial accounts, and you are to put those into proper statements and come up with the 3 answers. The 3 answers are earnings before interest and taxes is 160,000. Net income is 78,000, and cash flow from operations is $98,000. Those are the correct answers. And here is my thinking behind this. Naturally, sales is an income statement item. $10,000 for cash dividends. That has nothing to do with any of this information that you need to find. Remember, cash dividends are cash flow from financing. All right, cash flow from financing. So they have nothing to do with income statement or the cash flow from operations. So you just scratch off cash, $10,000 cash dividends, not part of this problem. $300,000 cost of goods sold, yes, expense. $20,000 administrative expense, expense. $20,000 depreciation expense, the expense. $40,000 interest expense, yes, but interest expense comes after the earnings before interest and taxes. $10,000 purchase of productive equipment. That, again, like cash dividends, has nothing to do with this problem. That is the purchase of assets, capital assets, fixed assets, equipment. So that's part of the cash flow from investment. It has nothing to do with any of these 3. So along with cash dividends, $10,000 purchase of productive equipment is not included. Then I tell you, and this is important to determine the cash flow from operations, that there's no changes in working capital. And to determine the net income, you're going to need to know the tax rate of 35%. So putting all that together and not including cash dividends and purchase of productive equipment, as you can see, we have sales, less cost of goods, less administrative expense, less depreciation expense. There we have $160,000 operating profit, earnings before interest and taxes. Then we subtract out the interest expense of $40,000. Now we have $120,000 of earnings before taxes, of which we take 35% of that $120,000, and we get our income taxes at $42,000. Thus, we get our net income of $78,000. The cash flow from operations, remember the definition of the cash flow from operations, as we discussed last week, is the net income of the company, the depreciation expense adding back in, and any changes in current assets or current liabilities, and that is working capital. So in this problem, we know the net income is 78,000. We know that the depreciation expense was $20,000, which is a non-cash expense. And we also know there's no changes in working capital, current assets or current liabilities. Thus, our cash flow from operations is the net income of 78,000 plus the depreciation added back in, and the answer is $98,000. Now, if you had this problem incorrect, but you showed me some of your work, you've got credit points. Remember, this is the largest point problem of the assignment, 15 points. So if you just put a number down and it was incorrect, you got pretty well dinged for a lot of points. But if you showed me your work or showed me how you came up with that number, even though it was wrong, you received quite a few points as far as grading. So double check your answer, double check how I graded that. If you have any questions, please let me know. Question number 8 was to define from chapter 4 the main areas of financial and analytical measurement: leverage, liquidity, efficiency, and profitability. Chapter 9 was to define what a profit and loss statement is, or a net income statement. And question 10 was to go to one of the companies in your portfolio and tell me for the last 3 years what their earnings per share was. And everybody did a great job on this. I was very impressed by you going into the internet, researching and getting that information. Good job on that one. So that was assignment number 2. And primarily the main area of points taken away was in question 7, because that was not an easy question. That needed you to do a little bit of thinking, of understanding what these financial statements are made up of. So overall, good work by everybody. The grades are posted, the solutions are posted, all in Blackboard. Okay, our subject this week is the time value of money. We had a good spreadsheet in our lecture video on Monday, introducing the week, about explaining the time value of money, how to do the calculations in the spreadsheet. Remember, that is in your week 3 file folder in Blackboard, that spreadsheet that could come in handy to explain calculations using spreadsheets for the various types of time value of money: present value, future value, present value of annuity or cash flow, amortization. Here's a video I'd like you to watch explaining this process again in a different perspective.
Whenever we talk about money, the amount of money is not the only thing that matters. What also matters is when you have to get or when you have to give the money. So to think about this, or to make it a little bit more concrete, let's assume that we live in a world that if you put money in a bank, you are guaranteed 10% interest, 10% risk-free interest in a bank. And this is high by historical standards, but it'll make our math easy. So let's just assume that you can always get 10% risk-free interest in the bank. Now, given that, let me throw out scenarios and have you think about which of these that you would most want. So I could give you $100 right now. That's option 1. I could, in 1 year, instead of giving you the $100 immediately, in 1 year, I could give you $109. And then in 2 years, this is kind of option 3, I'd be willing to give you $120. So your choice is, someone walks up you up to the street, I can give you a $100 bill now, a $109 bill, or not a $109 bill, $109 in a year, or $120 2 years from now. And you know in the back of your mind you can get 10% risk-free interest. So given that you don't have an immediate need for money, you're assuming that this money you will save, that you don't have to, that you don't have a bill to pay immediately. Which of these things are the most desirable? Which of these would you most want to have? Well, if you just cared about the absolute value or the absolute amount of the money, you would say, hey, look, $120, that's the biggest amount of money. I'm going to take that one because that's just the biggest number. But you probably have in the back of your mind, well, hey, I'm getting that later, so there's maybe something I'm losing out there. And you'd be right. You'd be losing out on the opportunity to get the 10% risk-free interest if you were to get the money earlier. And if you wanted to compare them directly, the thought process would be, well, let's see, if I took option one, if I got the $100, and if you were to put it in the bank, what would that grow? What would that grow to based on that 10% risk-free interest? Well, after 1 year, 10% of $100 is $10. So you would get $10 in interest. So after 1 year, your entire savings in the bank will now be $110. So just doing that little exercise, we actually see that $100 given now, put it in the bank at 10% risk-free, will actually turn into $110 in a year from now, which is better than the $109 1 year from now. So given this scenario, or given this kind of situation or this option, you would rather do this than do this. You're better a year from now, you're better off by $1. What about 2 years from now? Well, if you take that $100, after 1 year it becomes $110. Then 10% of 110 is $11. So you want to add $11 to it. And so it becomes $121. So once again, you're better off taking the $100, investing it in the bank, risk-free, 10% per year. It turns into $121. That is a better situation than just someone guaranteeing you to give the $120 in 2 years. Once again, you are better off by $1. And so this idea that not just the amount matters, but when you get it, this idea is called the time value of money. Time value of money. Or another way to think about it is, think about what the value of this money is over time, given some expected interest rate. And when you do that, you can compare this money to equal amounts of money at some future date. Now, another way of thinking about the time value, or I guess another related concept to the time value of money, is the idea of present value. Present value. And maybe I'll talk about present and future value. So present and future value. So given this assumption, this 10% assumption, if someone were to ask you, what is the present value of $121 2 years in the future, they're essentially asking you, so what is the present value? So the present, PV stands for present value. So what is the present value of $121 2 years in the future? That's equivalent to asking what type of money or what amount of money would you have to put into the bank risk-free over the next 2 years to get $121. And we know that. If you put $100 in the bank for 2 years at 10% risk-free, you would get $121. So the present value here, the present value of $121 is the $100. Or another way to think about present and future value, if someone were to ask, what is the future value? So what is the future value of this $100 in 1 year? So in 1 year, well, if you get 10% in the bank, that's guaranteed. Its future value is $110. After 2 years, its 2-year future value is $121. And so with that in mind, let me give you one slightly more interesting problem. So let's say we're going to assume this the whole time. That makes our math easy, a 10% risk-free interest. And let's say that someone says that they're willing to give us $65 in 1 year. And we were to ask ourselves, what is the present value of this? So what is the present value? What is the present value of this? So remember, the present value is just asking you what amount of money that if you were to put it in the bank at this risk-free interest would be equivalent to this $65. Which of these two are equivalent to you? And so you would say, well, look, whatever amount of money that is, let's call that x. Whatever amount of money that is times, if I grow it by 10%, that's literally, I'm taking x plus 10% x plus, let me write it this way, plus 10% times x. Oh, let me make it clearer this way. X plus 10% of x should be equal to our $65. If I take the amount, I get 10% of that amount over the year. That should be equal to $65. And this is the same thing as a 1x, or we could say that 1x plus 10% is the same thing as 0.10x is equal to 65. Or you add these two. 1.10x is equal to 65. And if you want to solve for the actual amount of the present value here, you would just divide both sides by the 1.10. And so you'd get x is equal to, let me do it this way, be a little bit more clear about it. So let's divide both sides by 1. And really that trailing 0 doesn't matter. We're not really too worried about the precision here because this is actually exactly 10%. So this is going to be, these cancel out, and x is going to be equal to, let me get the calculator out. X is going to be equal to 65 divided by 1.1, $59.09, rounding it. So x is equal to $59.09, which was the present value of $65 in 1 year. Or another way to think about it is, if you wanted to know what the future value of $59.09 is in 1 year, assuming that 10% interest, you would get $65.
Okay, one of the, I wanted to show you that video just to show you how mathematically we can calculate this, but naturally and as we went over those problems earlier this week, you can do this a little bit simpler using your spreadsheet information. But if you want to use a calculator, go right ahead. But it's just a lot easier using a spreadsheet. Again, these are the problems you're practicing this week in assignment number 2. Different ways of looking at values of money in the future, in the present, and in a series of cash flows, and in borrowing or loan payments. Different ways of looking at time of value of money that we're going to be studying throughout the remaining 6 weeks of our class. And but by the way, it's speaking of weeks of class, it's hard to believe next week, week 4, is our halfway point. Amazing. All right, everybody, that's it for this week 3 weekend video, complete assignment 2. We'll see you on Monday with a discussion of stocks and bonds as we get prepared to talk about capital investment in the second part of our course. If you have any questions about the assignment 1 grading, please feel free to send me an email or let me know. And until next time on Monday, we'll see you then. Bye-bye.